Good evening, everybody. Thank you for joining us for our Silicon Valley real estate market update this evening. Want to jump right in. Thank you for coming or listening in online. And just a quick reminder, we do this every week, and we're going to get into why we do this every single week. So if you're listening or watching this for the first time, we do go a little bit fast, and what we're trying to accomplish is help you understand what the real estate information that you're hearing out there from friends, family, neighbors, the media, what it means, how to understand it, how to digest it, and then why it doesn't drill all the way down to what you're thinking of when you're thinking of buying or selling, or people you know they're thinking of buying or selling. So hopefully the next 20, 30 minutes, we'll do a good job explaining our methodologies, what we do to stand out and help you make some really important decisions in your buying or selling of property here in Silicon Valley. My name is Robert Cruz. I'm one of the principal partners at the Lutz & Cruz Group here at Keller Williams in Cupertino. While we're located in Cupertino, we work all over the Bay Area. The kind of information and knowledge that we're going to share, we can apply in all these different places. So stand by, and if you have any questions, just raise your hand, or if you're on Zoom, just hit the button there or type in your question, and we'll address it as it comes up. But again, my name is Robert Cruz. I've been a broker here in Silicon Valley for over 20 years. This is my 21st year actually in this market. In that time, I have seen the absolute highs and the absolute lows. But fortunately, I wasn't just a participant. I was actively engaged in reading the market, understanding the market, kind of communicating to buyers and sellers what was going on. And then for a long time, communicating principally to realtors, training realtors on the market, on the dynamics, on what was pushing prices up or down, how our markets were changing, how are they reacting to local economies, national economies, and things like that. So we're going to present a little bit of that tonight. That's the context of what you'll be hearing. But again, thank you for coming. Thank you for joining us. And if you have any questions, feel free to interrupt me either online or here. And with that, we'll jump in. So I like to start off usually with kind of the kind of information that you'd be receiving on a national level, because that's usually how real estate news is released, whether it's online, magazines, virtual or real, news programs. You're probably hearing a national perspective on what's happening in real estate. Now, I think that's incredibly important. I love real estate data. I love reading and finding out and trying to figure out what's going on nationally, because it's proper context for what eventually would be a local decision. And I strongly feel if you don't understand what's going on in the larger markets, it's harder to explain what's happening locally. So we'll start there. And one of my great mentors I really like is Lance Lambert, who writes for Fortune magazine. And he put out a really great article just a couple of days ago, actually yesterday, February 1st. And I'd love to start with the title. We're in a bifurcated housing correction. Just look at these four charts. I'm not going to show you all four charts, but we'll talk about what that means. But let's start with that title. We're a bifurcated housing correction. There's a loaded statements there, right? The first part, bifurcated, means there's two different markets. There's two different things going on in different places. And then, of course, the housing correction. Housing correction is a loaded term, right? It means there's been a big change in the market, usually to the negative. Now, it's important to understand when they say correction, they're first talking about number of transactions. And in that sense, this is correct. We were experiencing 30 to 40% fewer real estate transactions in most of our markets, including locally, year over year. That's a massive change. I don't care what good or service you're talking about. If there's 40% fewer sales, what you probably infer as a consumer, there must be something wrong. Something is not right, or we'd have more sales. That's natural. That's normal. That's probably the correct thinking to have as someone thinking of buying or selling real estate. The second part of a correction, when you're referring to a real estate correction, is price. And so usually, or in this case, while we have experienced some pricing correction, negative downward trends overall, they're not that big. What I mean by that, we'll talk about that in a second. But in the context of this article and the news you're probably hearing generally, it's generally bad news about real estate in terms of what's going on with values. Is our equity protected? If you're thinking of buying, is this the right time? And if it's the only time or the best time for you, are you offering too much, too little? What's going on? Of course, as a seller, you're trying to protect the equity you've gained over the last several years. And so these things might worry you. Is it the right time to sell? Will you be losing money if you sell right now? So let's go into that. Deeper into the paragraph, the second paragraph, the writer says, not long after the Fed began raising interest rates, spiked mortgage rates caused the U.S. housing market to slip into what Fed Chair Jerome Powell calls a difficult housing correction. There's that word correction again. That abrupt slowdown caused home transaction volumes to crash across the country in the second half of 2022. Again, that part of the mean of correction is right. 40% drop in number of sales. The second part is, additionally, U.S. home prices, as measured by the seasonally adjusted Case-Shiller National Home Index, which prior to 2022 had not fallen on a monthly basis since 2012, declined 2.5%. There's that second part of the correction. What's going on with prices? So the first part is dramatic. It's drastic. It's a lot, way fewer transactions happening. The second part, the actual price, which when it comes to consumers is the most important part. Realtors feel it certainly when there are fewer sales. It's our livelihood. But as a consumer, whether worried about prices continue to go up as a buyer or prices perhaps falling, values falling as a seller, it's only a small shift, 2.5%, right? And another important thing on this in this article is that reference to the Case-Shiller National Home Index, right? And I always like to follow what the Case-Shiller Index is showing us and how it portrays what's happening in our real estate markets. As a general person out there thinking or reading or hearing about housing, when you're hearing people reference whether the markets are up or down, almost universally, not always, but almost universally, they're referencing the Case-Shiller Index. So if you're thinking of buying or selling, you should be aware of what the Case-Shiller Index is. A lot of the information you'll get, a lot of the advice you'll get can ultimately be pushed back to this. The S&P CoreLogic Case-Shiller Home Price Indices are the leading measure of U.S. residential real estate prices, tracking changes in the value of residential real estate nationally. Now, there's a couple of really important points about this index. It does track monthly change in the value of single-family U.S. homes. It's based on the repeat sales pricing technique developed by the economists for whom the index is named. What that simply means is when a home sells anywhere in the cities that they monitor, let's say a home sells for $500,000 last Monday, they look at what did that home sell for the last time it was on the market for sale. And let's say it sold for $500,000 this time and it sold for $300,000 last time. 2 years, 5 years, 10 years ago, it doesn't matter. That's what they used to calculate our values going up or down. When they compile all the hundreds and thousands of transactions over time, you can see how they start creating the basis for their index. Is it up or is it down? Also, they supplement the composite index tracking the prices in 10 and 20 key US metro areas, as well as indexes tracking sales based on the home's price relative to the market average. A lot of words, a lot of talk. What the point here is, again, very, very important. Generally, when you're hearing conversations about is the market up, is the market down, it's referring to this. Not unlike if you're tracking stocks, right? If you're tracking stocks, while you may hear about individual stocks, they usually always reference what's the S&P 500, what's the Dow Jones doing, or other indexes that go across class to give you a general idea of what's happening in general in the market, right? You first figure out what's going on generally in the market, And then you might want to track what an individual stock is doing against that index. That's the same principle here. So important to remember. Now, here's the other thing. The Case-Shiller index tracks monthly change in the value of single-family U.S. homes, and it's calculated using a 3-month moving average of home sales that were entered in public records September, October, and November, when they release it for November, which they just did yesterday. So it reflects deals made largely in August through October, which makes the original offers go back as far as June and July of 2022. Now, here's a really important part, because what I say next might sound like I'm denigrating or talking down to what the Case-Shiller index is, and that's not what I'm doing. It's incredibly valuable. They're very smart people putting it together, and it helps a lot of people across the country kind of set their feet on what's the market doing. But like tracking a stock or index fund and then comparing it to an individual stock, that's kind of what you need to do if you're thinking of buying or selling a house. You want to know the environment. You want to know the general mood out there. You want to know, is the market trending up or down? But ultimately, you'll have to decide based on a neighborhood, based on a street, based on a particular house, the one you're selling or the one you want to buy. And this is why this context is so important. We just released the November data for Case-Shiller index. It says overall sales are down 40%. That's true. And it says that the prices are tracking down 2.5% nationally. But this was for June, July, August, September, October, November of last year. This was the period when interest rates hit 7% and stayed close to that. And the markets did. The buyers reacted and said, we're not buying at these prices and those interest rates. So just yesterday, we released that data. Well, we knew that because we lived it, we experienced it, right? And so always remember that. As you're hearing references to what's going on in the market, it's backward looking. And it's looking at what happened 3, 4, 5 months ago. Now, the square there represents those months, June, July, August, September, October, when that data was compiled. But it also, if you notice the squares, the rectangles there, that's average days on market in Santa Clara County. So I want this graphic to really illustrate what I'm trying to point out here. When you're reading or hearing what's going on with real estate for the first time, and you see a lot of that information is based on information that's months old. And even as recent, it's still November data, and we're in February now. And so you can see going into those months in June, the market was, homes were lasting in the market only 14 days. The longest period here was 29 days in October. December was 32, but I'm talking in that square. So about 30 days, put it at 30 days. That means every 30 days, we have a new real estate cycle. So when you report what's the market doing, and it's using 6, 7, 8, 9 month old data, right? It doesn't reflect what's happened in the last few days when we completely turned over a new market. This is the importance of local knowledge, local information, and how we come to find out what is actually going on when you're thinking of buying or selling locally in Silicon Valley. This is valuable. This is important. It tells you generally what are the trends, but ultimately you have to know what's happening here and what's happening now. And even more important than that, it's not what happened last month. If you're talking to us about buying or selling, you want to know what's going to happen in the month when I buy or sell a property. What's happening this month, next month, or spring, if you have a timeline that far out. That's really at core what you're expecting from a real estate professional when you're looking at thinking of buying or selling. So we have to be ready to answer those questions using forward-looking data. And that's what I wanted to set up here. That's why I start with this, right? A lot of other factors out there in terms of what's going on in real estate. This is a great map from the same article. It's showing areas of the country where real estate prices are retracting and where they've stayed stable. And you can see it's pretty obvious. All of the West Coast is where the close to double-digit retrenchment in prices is happening. Now, a couple important points. That's from the peak, which was around June of last year. So from the peak of last year, prices have gone back around 10%. Now, another part there is that's measuring median home prices. Median simply means Half the homes are more expensive than the median price, half the homes are less expensive. What happens when we have a period like we experienced in third or fourth quarter of last year, when buyers pull back, offers are fewer and farther in between, and especially when we're leaving a market where buyers were paying way over asking price, soaking up everything in the market, what you will tend to see is the higher priced homes in every market get off the market. Generally speaking, they don't have to sell if they're not going to get their price, so they just stay off the market. The lower the prices get, the more likely they have to sell, and even if it's not conducive, they have to stay on the market and get the best offer they can. So whenever we get these immediate drops in buyer activity, the median price immediately drops because the higher price homes come off the market. I'm not saying that you shouldn't worry about lower prices, but understand what they're telling you. They're telling you the median price has dropped around 10% on the West Coast. That is real, that is important. It still doesn't answer the question, what do you need to offer to win, or what should you expect when you sell your house? Again, it's a starting point. It helps us set the baseline for what we would discuss with you about those questions. What's my house worth? What should I offer for this property? And mind you, and then I always like to remind people, again, my 20 years here in Silicon Valley, we always take the highest ride up and we always take the fastest ride down. It's just the way it is. Our prices and the volatility in our market tend to the extremes. We have way more activity, we have way more action. And again, because our swings are higher and lower, again, that makes it even that more important. You speak to someone that really, really knows what's going on. You won't win or lose by 1 or 2 or 3%. You could win or lose by 10%. And when our median prices are above $1.5 million, that's a lot of money. You can't make those 2 or 3% point mistakes when you're pricing or selling a property, right? So this is why we do the work that we're doing. Last slide I'll show you, this is one of the slides that's referencing the title, is that bifurcation of the housing market. And it's simply saying, in some places, it's not that bad. In some places, it's worse. Again, I showed on the map. Where is it the worst part? Here in California, here in San Francisco, San Jose Bay Area. And it says that. It shows you, if you can't, I don't know if you could read it, but the areas with the biggest shift in home prices, the peak of 2022, San Francisco leading the way at negative 10.5, Austin, negative 9.5, Reno, San Jose, Phoenix, Seattle, East Bay Area, here in the Bay Area, Las Vegas, Santa Cruz, Boise, all West Coast, all at or near double digits drop from the peak in around June of 2022. And it says further, and I think this is a really important part, during the pandemic boom, home prices in these so-called Zoom towns soared far beyond what underlying fundamentals like local incomes and such would historically support. What does that mean? Well, when people think of buying homes, they really look at location, they look at proximity to schools, they look at proximity to shopping and entertainment and jobs. What the Zoom town phenomenon refers to is when you can work from anywhere and you can go to school from anywhere and you can't go shopping and you can't, there is no entertainment because of lockdowns. Well, why would you pay premium home prices? Why wouldn't you go buy a home in Boise, Idaho while you're working at Apple in Cupertino? Because you could. And you can buy a house and go to school, same schools, go to the same job, get the same pay, and pay a fraction of housing costs, right? So there was a natural relocation from these areas into the secondary markets. Now I'm going to show you, well, how does that explain? Shouldn't that have dropped prices here locally? Well, no, because we had our own little Zoom town areas here, and I'll describe that. So that's what they're talking about. Some places had these outsized gains during 20 and 21 and into the first part of 22. And now there's that reversion to the mean of the prices are coming back into alignment in the natural trend up. When it goes too high, too fast, but you have a long-term positive outlook, you will get a reversion, which means it'll drop perhaps even below the long-term trend. But what you should always focus on is it'll always keep that upward motion going. So this is what we mean there. When the lockdowns were announced here locally, I used this chart when I was training think we would have like 600-700 agents at a time listening to what's going on, Robert, what's going to happen next, what do we tell our buyers and sellers. And one of the first things I told them was, look, we're here in Cupertino, let's get ready to sell homes in South County and in East Bay. Why? Because they don't have to work here anymore. They don't have to go to school here. So they can save $300,000, $400,000, $500,000, $600,000 on buying their next house in the South Bay or in the East Bay. And they still work here in the tech centers. The children are still going to the prestigious schools in this area, but it's all via Zoom. And so we saw this. So it wasn't just that they went to Boise, they went to South County and they went to East Bay. Now we know what's happening now in 2023. You got to be back in the office. All the kids are back in school. You can no longer Zoom. So the pool of saving in these outlying areas is no longer there. And we're getting the boomerang effect of coming back. So long way to say, look at these kind of dynamics. They're not just national, they're very hyper localized in some cases here. Understand that when we get these, what's going on in the market, and they're talking about these national levels, and they're referencing backward looking data that's 3, 6, 9 months old, it's still important, it's still valid. But again, you're asking us what's going to happen next. And that's one I want to jump into, right? Where does the home price correction go next? That's the answer we need to solve for you or help you solve, right? So there's really the 3-4 major factors that are going to play into answering that question. The first part is what's going on with lending, right? Even if you are buying with cash, the majority of buyers use a loan. And so the majority of buyers drive the market. So the availability of credit drives what they can offer on homes. We know mortgage rates jumped from 3% in the first quarter and early second quarter of last year, all the way to 7% around that June time period. That buyers crashed, dropped number of transactions by 30-40%. And so we track that. We want to know early on who's applying for a mortgage. And we do that because we know that when someone applies for a mortgage today, that means they're going to be buying a house in the next 2 to 3 months. So if we look backwards to know what's going on today, well, how many people were applying for a mortgage in October and November? I can tell you it was about 40% below the previous October, November. So we should expect the number of offers and activity in the market right now to be about 30 or 40% below what it was a year ago from now. So we shouldn't be shocked by the numbers. We can prepare for it. But that alone isn't going to drive prices down. If we know the number of buyers is dropping, right? Because there's 2 parts of the equation. There's also supply. We'll get to that in a second. So over the long period, the last 6-7 months, the number of applications has steadily dropped. But over the last, I would say like 10-12 weeks, they've gone up. Last week was the first time in 8 weeks that the number of applications went down. But that's only 1 week. The general trend recently in the last 8 to 10 weeks is more people applying for a mortgage. So what should we expect? More competition in the market for the properties that are available to sell. So again, the headline from June, July, August, when they were at 7%, number of sales are dropping. Right now, in every 30-day cycle that we operate here, it's coming back up. More buyers are into the market. And so that's one of the first examples of, if you're listening to national news and you're talking about corrections, both in units sold and prices, that can change in 30 days here locally, because that's how fast our markets move. If you only rely on the national data, they will tell you in June, hey, February is hot. It's kind of too late, wouldn't you think? Wouldn't you want to know in February, what's February going to be like? That's what we like to provide you. That's what we like to help you understand. This crazy chart, it might be hard to look at, but it's an incredibly powerful tool to help you make those kind of decisions. So this is over the last 18, 19, 20, 21 loan purchase loan applications, a leading indicator of what's going to happen next. We know what the markets did in 20 and 21 and 22. So if we start with, well, what do applications look like today, then we compare to those times. You can see down here, 2023 is the black line. very clearly and obviously less activity in purchase applications than the previous 3 years. Mind you, the previous 3 years are the best real estate markets ever. So you're comparing to outstanding high volume activity markets. It is real that we're down 30-40%, but from record highs, not from normal highs. So we're back into a normal market in that respect. The headlines are not lying. There are far fewer people applying for mortgages. If there's far few people applying for mortgages, then there's fewer offers written, fewer contracts accepted, fewer sales. But is that enough to push prices down? That's the next answer, right? But you can see clearly when interest rates started to pile higher, the number of applications dropped, and we're still at a high. Not the sevens that we experienced not too long ago, but I think we had 5.99 today, right? First time we had a 5 in months and months and months. That is good news overall. How about the demand side, right? Classic economics, supply and demand. Well, here we see again, the purchase applications leading indicator. How many people are going out to look at homes? It is low and is dropping, but it has recovered. And when we compare this to demand, you're going to see why we don't experience the kind of price drops that we did the last time mortgage applications were this low. We're talking 9, 10, 11, 12, 13, right? We're at that kind of stage where people applying for mortgages at those levels. You can see here again, this is number of pending sales here in San Jose as an indicator for the entire county. And you can see once again, yes, it is trailing 22, 21, and 20. But again, those are the 3 best years ever. And it's not like we're way off the pace here. So this is healthy. If we put out the last 20 years, this line would look a lot better. But we're comparing it to the best 3 years. That's important for you to understand. And you can see the trend. We're entering a period where it will go up because it always goes up from right now through March and April. So if you're a buyer and you read the headlines that there's a correction and that you're expecting prices to drop, this is going to be incredibly important for you. Really look at the localized data, look at the leading indicators, and are you going out there prepared to write winning offers? If you're not, and these numbers hold up, if you miss next week, then the following weeks, the house will be more expensive. If you're a seller and you're thinking that the prices are not going to reach what you were hoping for, and it doesn't sell the first or second week, and you give up too soon, you might lose some money. So we'll get into that in a second. This is another graph to show demand that's out there. This is from a company called Showing Time that registers people to go and see properties that are for sale. And you can see these are the weekly averages for 2020, 21, and 22. Once again, there's a theme there. These were very high. These should start to be released probably next week. And what you'll see is we'll be able to track, are people going out to see properties at what levels compared to the previous 3 years. I can tell you it's going to be lower than the last 3 years, but it's going to be more active than most years. And that's, again, will get you from those big headlines that sound like really bad news into the information you need to make really important decisions. We'll finish with this, the supply. This is national. And you can see over here on the far right, it says inventory is down 1.4% this week. And it says inventory keeps declining, right? So, but what about here? Every Monday, I get up and I record the number of active properties we have in our county and the number of pending properties we have in our county, so I can track weekly, 7 days time periods, not from June, July, and August of last year. We know that because we read the Case-Shiller Index. But when you come and meet with me or one of my agents and you ask what's going to happen next, this is what we want to show you. So you can see that inventory from the very first week of this year has risen steadily. It's still rising. but from very low levels. The same thing is going on with condos and townhomes. So nationally, the news is fewer properties listed. Here locally, it's rising. How is that going to affect our local numbers? I think I missed the chart. Oh, we'll get to that one. So this is a concept that we teach here and we'll communicate with you. And that's the idea of the speed of the market. Remember, I was talking about they're looking at data going as far back as June. And here locally, our houses last on the market less than 30 days. So it's not just that you're looking at 9-month-old data. If you start a search today, you start looking at houses this weekend, and by the first week of March, you're not in contract, there's a whole new inventory of homes for sale. Those new properties are going to base their price on what the ones that sold in February sold for. So if the prices stay sticky or even rise a little bit in February, what do you think they'll look like in March? The sellers that list in March will price their homes slightly higher than the ones that sold in February. Now, it is true, if the homes that sell in February prices fall, then the sellers will price in that. But we see that because we look at it every single week. So you won't have to wait until June for national data to tell you what's happening next. We can tell you every Monday, or I should say every Thursday, because that's when we present this. I did the data on Monday, but I presented on Thursday. What you want to look for, this is national, this is everywhere. This is what happens in every single market. When you have a month's supply of less than 2 months, you generally have values going up. The pressure on prices is up. I just showed you, we're always at or below 30 days. So we're always in this part of the range, meaning usually our pressure on prices is higher. If we start to see the month supply go past 2 or 3 months, again, that's another early indicator that prices should fall. That's not me saying or wishing, that's just economics and what the numbers tell us. We haven't been above 30 days on market in probably 6-7 years. Now, what has happened to prices in Silicon Valley over those last 6-7 years? They've gone up 40, 50, 60, 70% in some cases, right? Simple demand. How fast is your market moving? Is it churning every 10 days, every 20 days, every 30 days, every 60 days? That's going to help determine what's going to go on with prices. So I cannot hide from you, and I would never hide from you, that when you start with national, regional news on what's happening in real estate, it doesn't sound great. It might be frightening to you. What we want to be able to do when you communicate with us is distill that all the way down to the local numbers. What's actually going on here? What are the factors that are going to affect your decisions to sell or buy? At what prices? What's the timing? Right? Everyone has different needs. Everybody has different timelines. We can help you make the best decisions based on those things. We cannot change the market dynamics. We cannot change what you need or want, but we can help you navigate that to make the best possible choice. And certainly not to fall to headlines that may or may not apply to you, right? If you go out there trying to write offers that are way below asking because you heard there's been a correction of 30%, that's a number of sales, not in price. So if you really want to buy a house and you repeatedly write below offers that will win, then you're pushing your purchase time 1, 2, 3 months out. And right now, the data says the houses will cost more in 1, 2, 3 months time. If you're selling, you don't want to lose or leave any money on the table. You don't, depending on what your timing of wanting to sell, it may make sense to do it earlier versus later. We'll explain that later. But this is the core of what we want to get to when you speak with one of us, right? Let me jump to what we actually show you. This is our county. This is properties for sale, sold, pending, and new listing. We start and look at localized data like this to really analyze what's happening. For any market you're looking in, we can take that. If you're in Almaden, if you're in Willow Glen, and you're priced between 3 and 2 million, we can distill it all the way down to any metric you want. But then Again, we're not comparing 8-month-old data, we're comparing 7-day-old data. And we're not comparing what's nationally going on, what's going on in Boise or Austin or anywhere else, or even in Sunnyvale or Morgan Hill. What's going on your street? What's going on with your property? What's going on with your value? And you can really drill down and give you really rock solid advice. Another number that we look at that's super important is this absorption rate. Most realtors don't talk about this. They frankly don't understand it. And it's not that popular. I don't know why. And it's because usually when we talk about how fast our home's selling, we look at days on market and we talk about how long will it take to sell all the inventory. And the old saw is if it's 3 to 6 months, it's a seller's market. If it's less than that, it's a buyer's market. I'm sorry, that's reversed. If it's more than 3 to 6 months, it's a buyer's market because nothing's selling. If it's shorter, but I just told you or showed you for the last 6, 7 years, everything's below 30 days. So why do we measure based on months? We should measure based on weeks. The absorption rate is the inverse of the days on market. It measures, regardless of how many homes are on the market, how fast would they sell? So in a 30-day month, if we have 30 houses on the market and they all sell by the end of the month, we have a 100% absorption rate. If they all sell by the 15th of the month, we have a 200% absorption rate. So the higher the absorption rate, the greater the demand buyers show, right? And because it's for pending properties, those won't record as sold and won't be measured for 30 to 60 days. But because so few properties fall out of contract, when I see absorption rate in a certain market is elevated, that tells me what the data will show in 30 to 60 days. 2 local real estate cycles, right? So currently the county is at 77%, which looks low compared to the highs that we experienced 12, 13 months ago. But again, those are record highs, 290%, 300%, that happened and they existed. And that's why properties were selling in 3 days for 15, 20% over asking price. Now we're just at a normal seller's market, but we're still a seller's market. Anything above 15% is considered a seller's market. But that's not what the headlines say, but that's what the data says. The data tells us, understand the numbers, understand the realities, don't fall to what we're measuring from a high. What's actually going on with your property, leading indicators. You can see again, historically, we're like right around the range of where we are historically. This is what everyone's measuring against, that massive jump just recently. So let's go to a local market and give you an idea of what we're talking about. Number of homes for sale, number of people buying, and what does that look like? So we see here, these are the major areas here in Santa Clara County. And this is measuring on the 5th Monday of each year, how many homes we have for sale, higher or lower than the previous year. So you can see, for example, Cupertino and Santa Clara, 9% and fewer homes for sale this 5th Monday of the year compared to last year. Inventory is falling there. Cupertino and Santa Clara are primary markets here. So when there's fewer homes for sale in Sunnyvale and Santa Clara, Cupertino and Santa Clara, what do you expect prices to do there? These are still incredibly important markets, usually the first choice for buyers looking to buy in this valley. So we're depressing the number of homes for sale there. And why? Because the people that already own it don't want to get rid of it. They're in a perfect spot. It's close to the jobs they have to go back to. It's close to the schools their kids have to go back to. It's close to the shopping entertainment that they can now enjoy. They're living the perfect place. Why would they sell it? And oh, by the way, it's increased in value. So you're going to have to be very aggressive to take that property from them. The pressure on prices there is going to jump in the short term, right? Now, the way our markets work here, we know because we've been experiencing it. We do open houses on the weekend and we see 50, 60, 100 people in these open houses. Only one can buy it. But if 5 or 6 offer on it, this weekend, despite the headlines, they're in competition. All 5 of us want it, but who'll pay the most? 50 people there, 100 people there, 10 people making an offer, only one wins after multiple offers. Guess what happens? Well, the prices go up. And the neighbor that lists next week, like, well, they got 1.6, we'll ask for 1.7. Of the 10 people that offered, 1 or 2 can no longer afford that price. So what are they going to do? They're going to shift down south. And they'll help push prices up in the rest of the valley. This is the kind of localized, hyper-local, specialized information you're going to need to make the kind of decisions you're thinking about in buying or selling. Now, don't take it as bad news when I'm basically saying, you, in the short term especially, you should expect prices to go up. Good news for sellers, good news for buyers. Why? Because once you become the owner of that property, then you get the write-up in equity, especially over the long term. So every case is different. Everybody's wants and needs and timelines are different. You can see locally, it's different. Everywhere has different numbers. But when we do the trends over time and we look at the numbers, we can really show you what's going on. I'll finish with this. Let's say you're thinking of buying in Campbell, for example. If you come to one of us and say you're thinking of buying or selling in Campbell, you're going to want to know what's next. So we'll show you something like this. And it's a simple chart. The dark line here is the absorption rate, that pending sales, that future looking number. This is always a great indicator for what's going to happen to prices next. When the absorption rate is super high, that means a lot of people are writing offers on the properties in this market. It's going to push the prices up, and it always leads the number. This lighter line is the list to sales price ratio. What percentage of what the homeowners were seeking did they get? You can see when the absorption rate jumped up to 900% in Campbell, the list to sales price ratio jumped to 120%. These were the headlines you heard last spring. 10 offers, 20 offers, $200,000 over asking price. Who knew? Well, we did, because we read the absorption rate. When the absorption rate started to tank, as interest rates went up and values went up, the list to sales price ratio followed until it stabilized right around July. And it's maintained at right between 95 and 100% of list to sales price ratio. So you start and we start with the national news. What's going on? What are the trends? What are the big factors pushing prices up or down? But we have to get to what's happening on your street, where you're looking. And then when we understand what your condition is, what your plans are, what your timeline is, then we can really fine tune the localized information to help you make important decisions. When we make 1 or 2%, 3%, 4% judgments with your help, that's a lot of money in this market. That's why we put in so much time and effort in analyzing and studying the market. So when you come to us, we are able to provide that extra layer of information and knowledge to help you make those decisions. So really thank you all for listening in. There's a few of you online. If you have any questions, you can type them in, or simply you can contact whoever invited you tonight and say, I'd like to get more information. I'd like to find out what's going on in my neighborhood and with my property. We're thinking of buying, we're thinking of selling. Can you do this kind of deep analysis for us and help us make decisions that are in the best interest of our family and our future? It's what we love to do. It's what we're prepared to do. And so I thank you again for joining us this evening. If you want the recording, if I spoke too fast and you want to check it out, the recording is available. Again, check with the person that invited you. I think by tomorrow or the next day, we'll be able to send you the recording. And we do this every week. Why? Because the data changes every week, every 7 days. The cycles right now are 25, 30 days. If you're just starting the journey and you're thinking of buying or selling in May or June, then you probably would like to be in tune with what's going on. Right? You don't want to look up in June and find out what happened in February, because that's what the national data will tell you. That won't matter anymore. What's going to happen next? All right. So thank you, everybody. Have a great evening, and just reach out and ask if you need any help. Thank you.